UK growth is back, but the question is whether it can last. What a difference a month makes. After contracting in October, the UK economy surprised to the upside. A welcome boost for a government that's put growth front and centre. But there's a sense of déjà vu. This time last year, a strong start quickly gave way to fading momentum. So is it another false dawn for the UK economy? Fiona Cincotta is Senior Market Analyst at City Index. So Fiona, this is the strongest monthly growth reading since June. Is the economy in better shape than we thought? And looking ahead, what does 2026 hold for growth?
I think on the surface, these look like really quite encouraging numbers. 0.3% growth, up from a 0.1% contraction in October, something to be cheered. But I think if we just have a look a little bit under the bonnet, it does leave some uncertainty, I think, over the sort of outlook of the strength of underlying growth, because if we have a look at these numbers, a lot of this rebound came thanks to growth in the industrial production, and that's very much linked to the recovery that we saw in Jaguar Land Rover as they returned to production following the cyber attack. So that feels like a very much a one-off boost to growth. I mean, if we have a look at service sector growth, that was okay at 0.3%, but again, nothing to be, super excited about. So I think it does mean that we do just need to be a little bit cautious about what this means for growth going forward. Obviously, we also had the budget around this period. So I think, there was some uncertainty heading into that budget, which may have just sort of kept the lid on growth. So we may see some encouraging numbers again in December. But you mentioned about 2026. I think there is reason to be cautious again in this year ahead. There are concerns about that increased tax burden. We're seeing a slight softening in the UK jobs market, which could make consumers cautious and just keep the lid on household spending.
Well, markets did react quickly this morning, with traders paring back, Bank of England easing bets. But 2 cuts by year end are still priced in. Does that align with your own rate outlook?
There could potentially be room for 3 rate cuts across the year, depending very much on how the UK jobs market holds up. I think that's what I'm really keeping an eye on at the moment. What's that unemployment rate looking like? If we see that sort of tick higher, and it's already at 5.1%, and I think that does have the potential to be ticking, up towards 5.5%, if not higher this year, in which case that will potentially see inflation cooling faster than expected. And let's not forget, the Bank of England did say that they actually expect inflation back to that 2% level around mid-2026. So there is room for not only inflation to cool, but potentially cool faster than what the Bank of England could be expecting, which would leave room for more rate cuts.
Well, could we see that disinflation come in as soon as next week with the CPI print due?
Potential to see that come through as soon as next week. I mean, I think that if I remember back to the last print, does feel like quite some time ago, pre-Christmas. But we did see a cooler than expected inflation print then. I think there is a potential to see that come through again, cooler than expected. And I think if we did see that, along with this rising unemployment that we're seeing, then that really may cement Bank of England rate cut expectations. I mean, April is being priced in at around 91% at the moment. February is only at 6%. So I think if we do see a cooler inflation, we could see that expectation surrounding February increase.
Well, UK borrowing costs fell to the lowest level in more than a year this week. Do gilts now look like a compelling long for 2026, particularly with a more supportive issuance backdrop?
There is a supportive stance there as well. I mean, as you mentioned, yields have come down quite considerably. And I think a lot of this is to do with what we saw from the budget as well. That actually brought quite a lot of relief to the bond market. The fact that the Chancellor gave herself such a big headroom is providing a boost in that respect, or should I say, is pulling yields lower. And so that, combined with the potential outlook for easing inflation, I think is also helping those yields remain low.
Finally, Fiona, Morgan Stanley strategists see sterling as the first major mover of the year and warnings about weakness are growing louder. Do you share those concerns?
I think there is a potential for sterling to have a difficult year this year. I mean, if we think about how sterling performed against the US dollar last year, it really did perform very strongly. I think it was around 7% increase across the year. It did weaken against the euro. So, it wasn't necessarily a wholly pound story. But I think this year, if there is that potential, as we're talking about, for the Bank of England to cut rates more aggressively than what's being priced in at the moment, that does mean that we could see the pound come under greater pressure across this year.
That was Fiona Cincotta from City Index. Don't forget, you can watch more videos on Reuters.com.